In the Indian capital markets, two distinct currents of liquidity are colliding. On one side, the short-term capital of foreign institutional investors, and on the other, the structural capital of domestic institutional investors. This macro line chart traces the historic divergence of those capital flows. A record ownership gap is forming as volatile foreign outputs are met with surging domestic holdings. If we zoom in on the data points from 2025 and 2026, we see domestic capital acting as a shock absorber. Local mutual funds, insurance companies, and banks bought into foreign sell-offs, creating a rigid baseline of support across the market. The primary anchor for this domestic influx is Reliance Industries. As the largest equity by market capitalization in India, it sits directly in the path of these institutional flows. Because of its sheer scale, professional domestic portfolios use it as a primary benchmark. Managers are forced to measure their own returns against the underlying performance of this single entity. This reliance on local capital has elevated the valuation floor for India's largest equities. For institutional investors, determining a precise intrinsic valuation for the market's heaviest anchor has become a technical mandate. Valuing a sprawling conglomerate presents a specific analytical danger. Applying a single consolidated EV to EBITDA or aggregate price-to-earnings multiple to a balance sheet this complex often leads to inaccurate price targets. Blending the financials of a deep-cycle commodities business with a hyper-growth technology asset distorts the math. This approach obscures margin vulnerabilities in one sector while masking the potential value of another. To solve this, top-tier equity researchers use a 7-step sum-of-the-parts or SOTP valuation framework. This methodology isolates each business unit before mathematically rebuilding the enterprise value. The process involves 3 steps: deconstructing return on capital employed, mapping internal flows of capital, and quantifying distinct margin headwinds. True intrinsic value is invisible on a consolidated balance sheet. It must be mathematically isolated through granular segment analysis. Step 1 is defining the business structure. A 4-quadrant matrix separates the entity into oil to chemicals, digital services, retail, and new energy. Step 2 isolates historical financials, starting with oil to chemicals, or O2C, the mature, cyclical cash generator. In fiscal year 2024, this segment faced cyclical headwinds. Revenue dropped 5% year over year, driven by a 13.5% decline in average Brent crude prices, compounded by new export duties on transportation fuels. Those headwinds are offset by a structural cost advantage. The Jamnagar refinery operates with high asset utilization, using multi-feedstock processing to protect refining margins. We now pivot to the digital services segment, GEO. Modeling its unit economics requires the same framework used for standalone global technology majors. The infrastructure scale here is significant. Migration to their true 5G and air fiber networks is driving a sustained increase in data consumption. The specific valuation drivers for GEO include average revenue per user expansion, a base of over 268 million 5G users, and the deployment of unlicensed band radio technology to capture the fixed broadband market. The commodity engine and the digital growth engine require completely different mathematical valuation drivers. Moving to the 3rd quadrant, Reliance Retail operates as an omni-channel retailer with enough scale to influence domestic consumer electronics and lifestyle pricing. This chart measures physical footprint against profitability. As the network expanded to over 19,340 stores, covering 79.1 million square feet, EBITDA margins reached 8.6%. That ecosystem now has a registered customer base exceeding 349 million people. The final segment is new energy. We model this as a long-duration option value, requiring a future discounted cash flow analysis. The capital commitments in Jamnagar are extensive. The company is constructing a 30 gigawatt-hour advanced battery gigafactory, with progressive commissioning scheduled between 2025 and 2026. The strategy relies on value chain synergies. They are integrating backward into cell manufacturing and battery chemicals to control the production loop. Furthermore, a technology licensing agreement with Nel Hydrogen anchors the future valuation of this segment to the cost-competitive production of green hydrogen. Segment isolation proves each unit operates in a different maturity cycle, demanding a bespoke valuation multiple. Step 3 analyzes capital allocation. To understand how this works, we view the conglomerate as an internal venture capital fund. This Sankey diagram tracks capital movement. The legacy O2C segment generates high EBITDA, channeled to fund capital expenditures for geo, retail, and new energy gigafactories. This structure funds capital-intensive tech projects while avoiding the external debt dilution seen in peers. This leads to step 4, segment ROCE. We deconstruct the return on capital employed for each discrete unit. A mature petrochemicals business generating 10% ROCE is valued differently than retail and digital services, which target ROCEs near 25%. This internal capital engine acts as a structural arbitrage. It captures low multiple cash from legacy commodities and reallocates it into high multiple, high growth equity. Evaluating efficiency only at the consolidated level obscures how this capital is being transformed into growth assets. The conglomerate structure is a closed-loop funding architecture designed to capture market share across multiple industries. Step 5 is management commentary. When calculating terminal value, we rely on the forward guidance provided by management. For example, models for new energy must factor in the target of building 3 million metric tons per annum of green hydrogen equivalent capacity by 2032. Step 6 is the SOTP execution. This matrix is where the segments are mathematically aggregated. We have rows for each unit and columns for EBITDA, assigned multiple, and enterprise value. We apply distinct multiples here. The cyclical O2C segment might command a 7 times EV to EBITDA multiple, while the retail division is assigned a multiple closer to 25 times. We multiply each segment's projected EBITDA by its assigned multiple to find its individual enterprise value, then sum those figures to establish the total enterprise value. To reach the final equity valuation, we deduct consolidated net debt, add cash equivalents, and divide by the number of outstanding shares to find the intrinsic value per share. The final equity target is sensitive to the assumptions made in each segment, which makes granular fundamental modeling a requirement for institutional accuracy. The final step is identifying key risks. An intrinsic value output must be stress-tested against segment-specific vulnerabilities. We must map how a global recession would compress gross refining margins in the O2C segment and model the impact of telecom price wars on Geo's ARPU. We also account for e-commerce disruption risks to retail margins and execution risks tied to the new energy gigafactory timelines. Institutional professionals only deploy capital if the market price offers a strict 20 to 30% margin of safety below the calculated intrinsic value. Systematic alpha generation requires deconstructing the conglomerate structure, mapping the movement of internal capital, and adhering to the strict outputs of a valuation matrix.